You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO, This Week in Futures Options, a show where we break down all the fun stuff happening on the futures option side of the fence. Could be indices, could be ags, could be fluid milk. You never know what the heck we're going to cover here on the show. That's what makes it so fun. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. You guys know how to get all of our shows, including TWIFO. Easiest place, of course, is grab it via the old iTunes. The network feed is where you want to go. You can always just subscribe to TWIFO, but the network feed will get you this show as well as the other pretty much dozen shows on our network. You never have to go anywhere. It all comes nicely delivered to your device of choice. Of course, if you really want to get it the second it is created, then of course head on over to the Mixlr, grab that live link. You can join us every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. Ask questions, send us comments, all sorts of fun stuff. We like to hear what you guys have going on over there. And of course, speaking of hearing things, we like to hear from you guys. So if you have questions, if you have comments, you can't tune in live, you want to hit us up after the fact, you guys know how to do that. The website, the social media, the email, info at theoptionsinsider.com, or questions at theoptionsinsider.com. That all works, all goes to the same place. So hit us up. We do like to hear from you guys. And joining me on the old program today, my cohort, my partner in crime, the founder of Bantix Technologies, creator of a little platform we like to use around here called Quick Strike, Mr. Nick Howard. Nick, welcome back to TWIFO. Sir, did that music get you in the mood to talk some futures options?
Oh, it always does. I still wish we had the This Week in Baseball theme, but I'll settle for this one.
I'll happily get that if you feel like forking over for the massive licensing fees involved.
I'll pass.
Yeah, exactly. That one. It's fun, but I don't know if it's worth the literal and figurative costs. And also joining us, holding down the CME Group hot seat this week is, appropriately enough, someone from CME. We have Agha Mirza. He is the global head of interest rate products over there at CME Group. Agha, welcome to the TWIFO program.
Thank you, Mark. I am excited to join you.
And Agha, as we are wont to do with all of our first-timers here on the network, why don't you go ahead and give our audience a little bit of an overview of your background in the derivatives space and what it is you do over there. What's a day in the life of the global head of interest rate products at CME like?
Certainly. I have 17 years of interest rate trading and trading management background prior to joining CME Group. I joined CME in 2013. As Mark introduced me, I'm the managing director and global head of interest rate products at CME Group. What that means is that I'm responsible for the management and growth of CME Group's interest rate futures and options products.
Yeah, it's not often we get a chance to talk about rates here on the show, so I'm glad to have you join us here, Agha, to let us do just that. By the way, if you guys want to follow along at home, of course, we have the live feed for the show. If you want to generate your own live reports, head on over to cmegroup.com/TWIFO, TWIFO. That's a cool thing because it allows you to generate the reports for free on the fly, and then Nick and his team usually activate a few extra little nuggets for you guys over there. So if you're listening live and you want to tune in to get the reports, you can see all the good stuff that Nick and I see during the show. And if you're listening after the fact, of course, just go back, make sure you change the settings on that report so that you'll see it till Friday so you can see exactly what Nick and I are seeing, at least through about 1:30 p.m. Central. If you put it on later, then it'll probably be a little bit extra volume, but it'll be pretty close to what we're seeing right here. But let's kick things off. Since, Agha, we have you in the hot seat this week, let's turn our attention towards rates. I know it's been, for a long time, the conventional wisdom was that the rates complex was kind of a dead complex. Wasn't a lot going on. That changed about a year and a half, 2 years ago, when Miss Yellen and her crew really started popping their heads up and saying, I think we're going to start maybe getting more aggressive on the rates front. And that, of course, injected a lot of volatility, a lot of action, a lot of movement in the curve. And things have been happening out there ever since. Now, of course, we have a pending change looming on the horizon. So a lot of things going on in your neck of the woods. Good timing to have you on. But maybe we'll start with a little bit of looking back. I'm sure 2017 and indeed January were both probably pretty interesting time periods for you. What were some interesting trends, some interesting highlights you guys saw over there in the rates side of CME?
We have had an interesting, exciting, and busy time in the interest rate complex over the last 2 years. As you said, we are delighted and very pleased that the efficient access to our markets and the deep liquidity pools in various interest rate instruments that have been created are proving to be extremely useful to our clients. And we are finding market participants and clients increasingly turn to CME for their hedging and interest rate risk management needs. What have we seen recently? 2017 was a historic year for interest rates here at CME. What people may not realize is that the year prior to that, 2016 itself, was a historic year. So we built upon a very strong year, 2016, and achieved a 9% growth, which is we had 8.2 million average daily volumes during 2017. What is also important is to note that when you measure liquidity participation, level of activity in our markets. There are multiple ways to do that. Volume is one. The other ways are open interest, which measures the outstanding size of contracts in our markets, large open interest holders, as well as liquidity as measured by the book depth. On all of those measures, our interest rate complex continues to grow. I mentioned that in 2017 we had 8.2 million average daily volume, up 9% from prior years. If you look at 2018, on volume basis, it is turning out to be even stronger. While we are only 1 month through the year, in 2018, we are running at 9.8 million contracts, which is up 16%. Just yesterday, February 1st, Thursday, we made an open interest high in one of our key product, Euro-dollar futures, at 15.3 million contracts. Again, that is open interest in Euro-dollar futures. There are numerous other examples, but I will highlight my favorite one, Ultra 10-year Treasury futures, which is a relatively new contract. It celebrated its second anniversary on January 11th last month. It's a new contract which we created to provide our clients an ability to track the 10-year point on the Treasury yield curve in a fairly precise manner. This new contract has grown to be the fastest growing and therefore most successful new product in 170 years of CME's history. And, that's something that we are quite excited about. Again, just on Thursday, February 1st, Ultra 10 Treasury futures made a record open interest high of 582,000 contracts. Last month, the ADV was near record at 154,000 contracts, and there is broad participation for a relatively young contract at 90 open interest at 90 large open interest holders. If I continue on, I'd probably be boring you with too many sort of records that we have seen in the recent months. But let me highlight another key development. Our options are looking particularly strong. If you look at the interest rate options complex, which is composed of Euro-dollar and Treasury options, two separate line of products, in last 5 years, that activity is up approximately over 200%. This year, again, we have strong growth, but what is most notable is that we have particularly strong growth in the electronic Euro-dollar options trading, which are up a whopping 105% since last January. And now, electronic Euro-dollar options make up a third of all our Euro-dollar options volumes. Those are some of the key highlights. I mentioned breadth of participation being an important measure of level of activity and health of marketplace. So it's worth noting that recently on January 16th, the overall interest rate complex reached a new high in large open interest rate holders at 1,987 participants. And finally, I would like to note that there is something very interesting going on with Treasury futures as they continue to outperform cash Treasuries on a notional basis. CME has maintained an index called cash market penetration, which essentially measures Treasury futures volumes as a percentage of cash Treasury volumes, and that index has gone from 56% just 5 years ago to a new high of 95%. Just in 2017, the relative usage of Treasury futures versus cash, the index that I'm referring to, picked up 14 points. So, certainly the significant growth and that all is testament to the growing, deep and consistent liquidity that our clients value very much and consistently turn to CME's rates complex for their hedging and risk management needs.
It's interesting you mentioned the electronic liquidity on Eurodollars, because I remember a time, it doesn't seem like it's too long ago, but it was a little while ago now, where a lot of people who were looking at these types of things and trying to develop electronic platforms and tools and analytics for Eurodollars confidently told me that it just couldn't be done. The Eurodollars had too many months and strikes and series, and it was just way too complex of a product to really be effectively replicated in an electronic environment. So fast forward a few years and to seeing those types of numbers going up on the screen, it is kind of interesting, because that comment always, it never sat well with me. I always thought that seemed like a bit of a defeatist attitude. And now here we are a few years later, and we're seeing Eurodollars doing exactly that. If ever there was a product that did not seem well suited for the electronic environment, it's Eurodollars. And even they're starting to make some inroads. Well, like I mentioned at the top of the show, Agha, it's not exactly a coincidence that we have you on this week. All eyes seem to be on the rates complex again these days. We have, of course, the big transition going on over there at the Fed, and whenever that's happening, people start asking all kinds of questions. What's going on at the Fed? What is the new term, the team there? What are they really keeping an eye on? Are they inflation hawks? Are they not inflation hawks? So what are you keeping an eye on over there at the Fed now that we're heading into new horizons there? And flip side of that coin, what should our listeners be keeping an eye on now that we have this new regime taking over there at the Fed?
When I say that the Fed is active, I'm certainly not saying anything new to our listeners. We all know that after holding rates essentially at zero or near zero for a period of 7 years, starting in December 2015, the Fed started to lift interest rates or their target federal funds rate gradually in December 15th, which they followed up with another rate hike in 16. Last year, the Fed did a total of 3 rate hikes. Fed policy is obviously hard to predict, and I'm no economist, but I will say that going forward, there is reason to expect potential action from the Fed. At Janet Yellen's last meeting this week, before the new chairman, Jerome Powell, takes over, the Fed decided against increasing rates. However, and I will quote an excerpt from the FOMC statement, which says that the committee expects that economic conditions will evolve in a manner that will warrant further gradual increases in federal funds rate. This excerpt that I just cited is quite consistent with what CME's FedWatch tool is telling us. For those listeners who may not know, CME makes a highly popular and successful tool called the FedWatch tool, available for free to the entire marketplace. It's available to our website, cmegroup.com/FedWatch. What this tool does is it takes the Fed fund futures trading prices and converts them into probabilities of rate moves by the Fed. And as I said, this is a tool that gets referenced into hundreds of media articles and on TV, and gets thousands of visits on our website. So what is the tool telling us? By the June meeting, according to the CME FedWatch tool, there is a 95% probability of another Fed hike. And by the last meeting, last FOMC meeting later this year on December 15th, there is a 60% chance of a total of 3 rate hikes. If you look at the recent history where we got only 5 rate hikes of 25 basis points since 2008, potentially getting 3 rate hikes means an active and busy Fed, and that is perhaps the reason why we are seeing some of the record trading volumes in open interest as people position their portfolios appropriately and exhibit their hedging and risk management needs. One more thing I will mention, and this is sort of separate from the FOMC and interest rate action, is the Fed's balance sheet. This is something that is on the market's mind as well. Many of you may know that as part of providing stimulus to the economy after the global financial crisis, the Fed increased the size of its balance sheet from about $1 trillion to $4.3 trillion. Starting last October, the Fed has started to reduce reinvestments of the maturities, coupons, and principals on its balance sheet. What that implies is that the market will have to absorb some of the new issuance that in the recent years Fed used to buy. There are estimates that as much as $1 to $1.5 billion on average of the new issuance will have to be or may have to be absorbed by the market, which essentially will likely or potentially increase hedging needs. So that's another potential source of increased volatility in the coming months and few years.
Nick, I can see you chomping at the bit over there. You're an old school rates guy. You spend a lot of time in the Eurodollars pit. It's not a complex we really get a lot of chance to talk about on the show outside of these moments where the Fed is on the radar. So I'm curious. You obviously spend a lot of time watching these. What is catching your eye out here in Eurodollars or just in general in the rates complex these days?
Well, first off, it's kind of funny when you think about when Agha mentions how they're breaking records with OI and volume, where we just cannot believe the OI and volume every time we look at the stirs, especially the Eurodollars, right? The treasuries obviously always have big volume, but the euros always seem to be breaking records because there's no comparison in any other product in terms of the volume and open interest. So the fact that there's continued, it's not surprising. But and the great thing, and we talked about this, this is our 89th show, I think, and the rates started to pick up a little bit when we first started this, but even during the time when it was generally pretty slow and pretty flat, they still had good volume, but now the volume in the OI is just tremendous. And for me, an indicator of that always, and to Agha's point about, the Fed being even more active than they have been over the last 18 months, I always look at where the action is on the curve. So for a while, it kind of, and that's the interesting thing about the Eurodollars that we try to talk about, right? There's all the futures. There's 10 years of futures contract, but the options really trade is almost 5 separate products or 6 separate products, right? You have the whites, the rights, the short reds, the short blues, the short greens, the short golds, and the short purples. So you can see that I'm looking this week. The high volume activity is in the front June contract, and when you get that front contract, the front month, the whites, when you see where the activity is starting to take place, or the highest activity is taking place out there, there's still tremendous numbers across the board. There's 600,000 way out in the greens, 500,000 way out there. But the fact that it's in at that kind of number in June, and the OI is 5 million in that contract alone, and that activity, people are moving up the curve, right? Because they're going to trade as the Fed starts to take action, because we'll have a meeting in the next meeting's coming up in 6 weeks, and then we have another one. So June's going to cover. I think June covers too, and Agha can tell me if that's correct or not. But you're going to see a ton of activity from there in, and it's really telling that you can see that the Fed is in action because of what's going on out there. So it's never, to me, it's the Eurodollars tends to be, we always like, oh, another 1.7 million in open interest increase this week, right? Another up 4%. It's hard because you got 42 million. So the other things we talk about, the other asset classes just don't have this kind of action. But that's really the thing that catches my eye the most, is the fact that that the high volume and the activity and the big open interest is starting to target where the Fed actions are going to take place, or just outside of where the Fed actions are going to take place. So that's something that we could, probably focus on going forward, or at least make more of an effort towards these Fed meetings to say, which contract months might be of interest. I mean, the other thing is the obvious, steepening of the term structure across the whole board of the Eurodollars, obviously, right? We're seeing that the spreads have gone, if you look at 18-month spreads gone from 41 basis points to 96 basis points, the front march to the DEES 2000 or the DEES 2020. Yeah, 2020 already. I can't even believe I'm saying that. The current march to the DEES 2020, it's almost over 0.5% difference in change over the last month. So there's going to be lots and lots of activity as the Fed gets more involved in the market. And then as we get those inflation fears, if we start moving down, then you're going to see the Eurodollars, at least in my experience, as we move up, people tend to hate that market. But as we move down, they tend to, as we move down, it becomes more inflationary. That trade's going to be even more exciting, because as we were moving up, or as the market or as the economy wasn't doing well, you move towards those calls, people just hammering the market. But now you just can't do that anymore. You have to play both sides of the at the money, and I think the records and the volume are going to continue, because we're just at the beginning of the story.
Yeah, and Agha, before we move off real quickly, Agha, he gave a nice little plug for your FedWatch tool. Listeners who don't know, Nick and his team actually built that tool, or at least gave a nice little visual overhaul upgrade to it recently. And anything catching your eye out there? Anything you want to make our listeners aware of, Nick, when they're checking out your newly revamped FedWatch tool these days? Mr. Nick, can you hear me?
I can hear you. Yeah, I had to use a new headset today. So, the only other thing I want to mention in the Eurodollars, and this was something that happened, and you could see this on the tool while we're live. If you go out to the short March contract, is that the question you asked me, or you asked me a general question?
I was asking about the FedWatch tool. I was just saying, Have you seen it? Nick Agha was nice enough to give you a nice little plug, so I was going to extend it for you and just talk about how you guys revamped it, and if you're seeing anything cool, if you want to at least give our listeners a little bit of an overview of what they're looking at when they see your newly revamped FedWatch tool out there these days.
Oh, I think it's pretty self-explanatory when you go out there. I did tweet a link to it. As Agha mentioned, it's very popular. Yes, and Agha and Mark, I appreciate the plug, but I don't look at it as our FedWatch tool. I look at CME's FedWatch tool, because we did build it for them. They were the intellect behind the process. We were just the implementers. But you can go out there, and it gives a nice look at where the current rate is and what the expectation in the future is. So cmegroup.com/FedWatch, that's the short URL to get there. And it's got the next 12 meetings on there. So, and it's got, if you're kind of a interest rate bid head, you can go out there and download the data yourself and reproduce things. We put everything out there so it's fully exposed. So there's lots of good info out there, and there'll be an addition to that tool coming up in probably at the end of this quarter, where we have more of an expected rate out there right away, so you can see what it looks like. Sometimes when you look at the bar chart, people don't always know where the rate is right now. When you're in an uncertain environment, you might have bars on both sides of where the current effective rate is. But this one will just basically tell you this is a probability of what the rate's going to be at this particular time. So we're always trying to update the tools. A lot of great input we get from the CME to keep those reports fresh and even more useful. So thanks for the plug. But it speaks for itself. that tool gets hit. That tool gets hit thousands and thousands of times, and even more so now that we're in the market.
That tool gets a lot of love out there because it is, especially with the overhaul now, it's a nice little visual thing. You can look at it in a couple seconds and get a good sense for, hey, what is actual money doing versus what analysts are saying out there. But Agha, one of the other areas I like to look at whenever we do a deep dive into a complex like this, the activity, the trends, the volume, the open interest, but also the volatility, the vol, what is going on out there. We're talking on some of our programs, and this one a little bit about some interesting aspects of volatility out there in the rates complex and the rate space. Obviously, now that we perhaps have a new regime in the Fed, things may be shaken up a little bit. People are starting to look ahead and ponder and scratch their chins and say, what is afoot here for the rates complex? What are you seeing, historically from a vol perspective, and what are you maybe anticipating going forward, Agha, as we're looking here at the rates and the volatility of the rates here in 2018?
The volatility is something to keep an eye out on. In 2016 and 2017, when CME interest rate products essentially made new records in overall volumes and on numerous other bases like open interest and large open interest holders, what was remarkable is that all of that increased level of activity took place in what would be considered historically a very low volatility environment. Because, for example, the key benchmark, the 10-year Treasury point used to remain in fairly tight ranges for a long time, 2% to 220 or 210 to 230. It would spend a lot of time in a fairly tight range, which essentially makes for a low volatility environment. As we have come into 2018, starting with late 2017, the volatility has picked up a bit as yields are breaking higher from the recent ranges. The 2-year yield has broken the 2% mark, and it's at kind of 215, 216. The 10-year yield has broken the 250 mark, touching 280. The volatility has picked up relative to last few years, but potentially it could go higher. Obviously, it's anybody's guess to forecast the future, and that's not what I'm trying to do. But we do observe that the Fed has hiked 5 times, that certain forward-looking measures of inflation might be firming up. The CME FedWatch tool that Nick described in terms of its look and feel is forecasting as much as 3 rate hikes at 60% probability, as many as 2 rate hikes at 90%, and 1 rate hike at 95% probability. So with the interest rate curve pricing rate hikes, with the Fed having very transparently and clearly communicated to the marketplace a pace and a schedule that they will use to reduce reinvestments from their maturing portfolio of U.S. Treasuries, agency debt, and mortgage-backed securities, all of that has the potential to add to volatility, hedging, and risk management needs.
And Mr. Nick, I know you spotted some interesting trades out there in Eurodollars. Anything you want to toss in for our crazy trade of the week coming out of the Eurodollars this week?
Yeah, I think the one that we have to mention was definitely crazy, and this is a trade that everybody would do at least on one side. I think it was on Tuesday in the short March, which is the March contract that expires in about 40 plus days on the red future, the red March future. There was a call spread, 98.375, 98.50, which on the floor, or in the old days we called that the 83.5 call spread. It traded for traded for 0. So somebody went out there and traded for no value, which is just crazy in and of itself. But,
even? Really?
Even. Traded even. Zero ticks. So somebody took that off. Don't get it. Don't understand. In the 83 strike, there was 23,000 was coming off the board from an open interest standpoint. So about half of that trade, and the other one was like an open. So yeah, traded even. So I think that's a pretty crazy trade when you have the ability to put something on for even, for zero.
You know what's crazier is who took the other side of that. That's the crazy part I want to find out about. Who gave it to him for even? That's
and I'm pretty sure. I think it happened. It wasn't a block or anything. It happened on the electronic. So it's really kind of interesting. So in any case, I think that could be that might be on the list, an early entry for the crazy trade of the year, actually, already at this point.
Yeah, you don't see too many much of anything going up for even dollars like that. I want to dig into that one a little bit myself and see perhaps who facilitated that. That has the whiff of facilitation about it. You're not going to come in and just pick that up in the open market on your own like that. So that's a bit of a head scratcher. Before we roll off rates here, pun intended here, Agha, really quickly, any takeaways you want to leave our audience with? Things to keep an eye on? Things perhaps you and your team are keeping an eye on here in the rates complex going forward?
I would say keep an eye on statements coming out from the Fed. Keep an eye on what is priced in the interest rate curve, and a very helpful, user-friendly tool, again, is the CME Fed Watch tool. Keep an eye on the level of volatility, options trades, the increased electronic options trading. So a lot going on, and potentially a number of drivers for trade ideas here.
Yes. Oh, I'm actually not on mute. I thought I was on mute. I was waiting to find my microphone icon. Just want to follow up to what Agha said. All those things he just mentioned, those are all things that you can track directly from the CME Group website. So there are volatility tools out there. There is a free tool called Quick Vol, which is available when you register for Quick Strike Essentials, which is the free pricing and analytics tool available on the CME Group website, which gives you 1 month of free historical volatility data. So you can go and track all these things. And then you even have a Treasury Analytics tool where you can go and take a look and see how the yield curve is changing over time. And especially in this, we just like we mentioned before, we're seeing some big separations from even a month ago in terms of just the Treasury yield structure. So those are all things that are easy for you to track, all things that you can keep an eye on, as Agha suggested, directly from the CME Group website, with all the free tools that are available to the users out there. CME Group.
If I may just add to that, the one-stop shop for all of these resources is www.cmegroup.com/IR. IR for interest rates. Again, cmegroup.com/IR. Once you are there, on the right-hand side, there is a full list of interest rate tools that you mentioned, Mark. CME Fed Watch tool, total cost analysis, facilitator of the roll activity, CFTC commitment of traders, Treasury Analytics, and so on.
All right, Agha, you can take a little break, have a little beverage. Nick and I are going to take a quick segue into one of our listeners' favorites, which is, of course, all things crude, all things energy. Interesting week again. You know, who'd have thought, Nick, that you would be talking about these levels a month or two ago? These levels would have seemed extreme. Some of the strikes we're seeing trading this week for size would have been crazy trades of the week not that long ago. And now here they are lighting it up. Of course, talking about all things WTI, crude settling out about 65 and a half out there, depending on where you're looking out there in the term structure. So giving up a little bit of that upside, but still you can't shake a stick at these levels if you're a crude bull out here these days. Taking a little bit of a break, but it's got to happen every so often. Vol, a bit of a mixed bag out there as well, kind of speaking to the kind of nature, or the undeterminate nature of the week. We had some months up a little bit, some months kind of down a little bit, kind of a mixed bag. Seemed like a little bit off net across the board. When we're looking at what's lighting it up when you're asking us, hey, what was driving the action, the volume out there? In terms of actually open interest, a good week, but a quieter week, up about 5% this week, which is kind of the norm for WTI out there. Usually in the 4 to 5 range is kind of normal. When you get up to 7, 8, 9, that's when things start really rocking and rolling. In terms of what was lighting it up out here this week, number one with the bullet coming out here in March. It was a close contest, but the March 60 puts taking the cake. March actually doing about 42% of the paper out there this week. Again, you guys can play along, cmegroup.com/Twifo, or head on over to bantix.com, BANTIX. Click on that sign up for Quick Strike link there, and you can get all this cool stuff and a lot more that Nick and I are always talking about here on the old show. Yeah, 60 puts in March, number one with the bullet, 32,000 and change lighting it up this week. The lion's share coming on Monday, actually, 12,426, 8,000, almost 9,000 coming on Tuesday. So a hot and heavy start to the week. Then it kind of tapered off throughout the rest of the week. Only 5,000 opening. So the 60 puts were where a lot of the action was this week in terms of just churning and burning, rocking and rolling out there. Then number two also coming on the put side, but actually on the call side, because we're going to jump out a little bit. It was a close contest for number two, but actually coming, this is what I was alluding to earlier, Nick. It was actually coming in the April 70 calls. And it wasn't that long ago on this show when we were mocking the Citibank guys for their ridiculous estimates of where their range of where crude could settle. But also the fact that we saw people playing in the 70s a few months ago, it seemed outlandish. It seemed ridiculous. It seemed like crazy, extreme, optimistic, bullish paper. Fast forward a month or two, and now all of a sudden the 70s are our number two hot strike with a bullet this week. So goes to show just what a difference a week or two or a month or two can make. In this case, the 70s were lighting it up. 27,000 contracts almost. Of that, 21,000 and change coming on Monday. Tuesday. So Tuesday was the big day for all things 70 strike out here. Net closing actually on the week with about looks like about 6, nearly 7,000 net closing. So a lot of that paper perhaps unwinding some earlier position. Maybe a 70 bull decided, I want to live and fight another day, or maybe perhaps they're closing out some shorts. Either way, we saw a lot of action on the 70 strike, which is just interesting in and of itself. It was not that long ago that we were talking about the 70s being just perhaps a bridge too far for this market, and when it seemed like we were capped in the mid 50s to low 60s, and now here we are looking at a lot of 70s action. Number three, hot on his heels, came back in March. The March 63 puts 26,000 and change. The lion's share coming actually on Tuesday, 7,600 going up there, about 6,000 almost going on Wednesday. The similar amount on Monday. Net kind of unched from an OI perspective. So again, a lot of back and forth on the puts in March. People maybe can't find the rhythm. People just going back and forth with a lot of action there on the strikes, as not a lot of net opening on either of them. The 70s also popular out here in June 2018. 70s doing about 12,000 contracts this week. So yeah, depending where you're looking, and that's not bullish enough for you. We've got 2,000 of the March 2019 80s going up this week. Let's see, they went up on Tuesday. Looks like 65s went up 1,000 too. So maybe 1 by 2 went up at that time, 65.80. We'll have to dig into the blocks a little bit and see if that was the case. Either way, both of those trades opening. So if 70 is not high enough for your blood, you want to go a little bit farther out, a little bit farther up the chain, then the 80s in March of next year are where the action was. And not to be left out, not to be undone, the puts got some action too, including far outlandish puts like the June 2019 40 puts, doing about 3,400 contracts this week out there as well. So it wasn't all calls all the time. There was a lot of puts in the front month, but as you get farther out, that 70 strike, Mr. Nick, just too alluring. Who would have thought a month or two ago that we'd be talking about all this paper on the 70 strike? So A, does that strike you as weird as it does me, or is it just a sign of the times? And then B, what else caught your eye out here in crude this week?
Well, I think we mentioned last week at the end, right? We had there was a push over the 66 mark as we were doing our show, and we talked about whether if they could continue that on Monday, that we might see some follow through, but it just wasn't able to do that. So we kind of fell back off, and we kind of rangy for this week. But I was trying to get your attention. The April had the 70 calls, and the report itself. It shows you the top strike for that expiration, but when the links are active like they are right now during the show, you can click on that top strike, and it'll open up and give you the top 10 list for that expiration itself. So interestingly enough, the 80 strike traded just behind that, almost 21,000, and that's 85% of that was opening. So you might have seen some people rolling up that strike, and you saw other 75s, 77s. So I think, like we talked about all the time, there's still people who want, like the April, if you look at the put call ratio, the calls are the winners there. So it looks like there's still some short-term bullish people out there. But then you look in the March, and you have the puts are way over in terms of the put call ratio. So maybe we're looking for some range trading over the next little bit, and then as we move towards the April contract, which has 40 days, which expires in March, we're seeing a little bit more activity on the upside there. So again, not much other than to say there, other than agree with you. Like we talked about, Citigroup had like between 40 and 70, right? That they said, well, it was going to be the range. And at the time, I think we laughed at it more, not so much because of that it was 70 that they said.
It was just so wide. It was ridiculous.
It was so wide, right?
Yeah.
It had been trading, 50, or it had been trading 48 to 54.
I think it was actually like 35 to 75 was their range.
Yeah,
something
it was
ridiculous.
Crazy, so, right. So I think that's why we sort of scoffed at it, because I thought you can do better than that. I mean, I could keep going. I could draw concentric circles around the current range right now and say it could trade anywhere from here and there, and not get paid to be an analyst over there. So, but we're there. No follow through. Even though with no follow through, we didn't have much of a change in volatility. So we had a pretty flat week. All in all, the price, futures were in a little bit today, so it was pretty flat up until today's session. And as far as what we're looking at every week, the 25 delta skew, we saw the calls get a little bit cheaper this week. The puts get a little bit more firm, but really not much of a change across the board. The 40, the March is a 12-day option, so we won't pay too much of attention to that. But the April contract is the 40-day option, and we saw the calls pretty much hang. Got beat up a little bit. They came in, and the puts got bit up a little bit. So, that's a very telling sign, right? Because there was no follow through, so people immediately took some wind out of those call sales, which we saw a lot of juice get pumped into those as we were moving higher over the last couple of weeks. And as we always do each week, we want to take a look, and Agha's groups don't have these problems in the treasuries with the weeklies because they're so popular and super liquid and just trade massive amounts. But we don't see the same. We saw some good activity last week in the weeklies for the treasuries, and that probably had a lot to do with that people trying to take advantage of that short-term push to the upside. But this week, not much. So maybe that's the trick, Mark. Maybe when we have bullish sentiment and a or even a continued bullish or bearish sentiment, that's when we get those short-term weekly contracts to trade in the crude. They don't need that over in the treasury and the stir complex because, stir complex, the weeklies aren't so great, but the treasuries, they don't need any help on the weeklies. But maybe we're starting to see a pattern here when we get a little bit of a push. People are trying to take advantage of that short-term push, play it more like a wild card bet, like more like a binary. But today, nothing, or this week, not much.
Yeah, it's weird because that March contract is effectively a weekly. So, they're trading a ton of that, so it's in the weekly strip there. So it counts as a weekly, even though technically it is a regular old monthly option. So they will trade short duration out there in the WTI, just not in the literal weeklies. It is an odd preference. Speaking of preferences, what were you guys preferring this week? What was moving and shaking out there on the old CME complex for this week? We know they list a lot of products. A lot of things are moving and shaking. To the upside, we had KC wheat doing about 5.25%, followed by feeder cattle. Again, this is just the pure underlying, so no vol, no OI, nothing like that. 2.5% on the feeder cattle. Corn, about 1.6. Wheat following right behind it, close levels. And number 5, our old friend, Class 3 milk, making an appearance in the top 5. Maybe next week we got to do a little bit more milk love on the old show. Mr. Nick, I'm lactose intolerant, so I wouldn't be able to do it, but Mr. Nick probably could do that for us. Also on the downside, Nat Gas taking it on the chin, off nearly 10% this week. Followed number 2 by Palladium, off 4.5%. Silver off 4.36%. Talked a little silver on the show last week. Werewolves taking a little bit of a break maybe this week. Probably excited that things are selling off a little bit out there. Followed by good old RBOB, 4.1%, and heating oil coming in on the number 5 spot to the downside off 3.7%. Not listed on this, which would certainly be in there, would be the old Bitcoin futures at CME, which are moving and shaking this week as well. About 2,300 on the tape here, looking at going into the show this morning in that Feb contract, the Feb, and just the CME futures in general, hovering around that 9,000 level, about 90.55, 90.70 out there. June actually a little backward in the futures out here coming into the show this morning. The June contract hovering around 9,000, while the front contract were about 90.70. I know you guys have thoughts on all things Bitcoin as well as a lot of other thoughts. So let's get to those in our final minutes. It is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, let's get to what you guys have on your mind. By the way, Camper, we didn't do our homework again this week. No patterns of corn vol skew. We're busy guys. You can't do your homework for you. I'm sorry, but that's a very in-depth question you asked, but a good one. So perhaps do a little playing on the old quick strike, and you can find those answers for yourself, because it's there. You just got to do a little bit of digging. All right, so let's move on. Agha, this one's right up your alley here. You kind of touched on this a little bit earlier in the show, but maybe you have some interesting addendums. This comes from Jackson. Jackson wants to know, quite simply, how is the new Fed share being reflected in the rates product? So we touched on this a little bit earlier. Agha, we're seeing your thoughts on volatility. That obviously will be an area where this is being played out. Also, what we're seeing out there in the curve. Obviously, it's still early days in terms of, the transition isn't really even done yet, so we don't really know for certain. But, of course, we're hearing speculation. But that said, Agha, are you seeing anything out there across your complex that would give you any thoughts on how the feelings for what this new Fed chairman may be like being reflected over there in the rates complex?
I would expect the new Fed chair, Jerome Powell, to continue the course that the Fed has been on. As our listeners may know, Jerome Powell has been a governor of the Federal Reserve, a voting member of the FOMC for a number of years. And therefore, one would think that the Fed is going to maintain its course. Having said that, what is very interesting is that the macroeconomic, the markets, and the interest rate environment almost never stays stagnant. Particularly now, it is changing and has the potential to change in a meaningful way. As we said earlier on, you look at the talk of forward-looking inflationary measures. You look at the CME Fed Watch tool pricing, as many as 3 rate hikes with 60% probability for 2018, as well as the Fed's balance sheet unwind, even though it has been communicated very transparently, and the whole process is extremely gradual. But with time passing, that unwind process will add up and will lead to sort of on a cumulative basis, the potentially significant hedging needs. So, while Jerome Powell has been part of the Fed and the FOMC for a number of years, the environment certainly has the potential to change. and we think that he will, or the Fed under his leadership, will take actions that are best for the economy. But that clearly could be more action than less. So time will tell, and that has implications for volatility.
I don't know if it's you coming on today, Agha. Are you getting people fired up about rates, or people are just have that on the brain these days? We got a lot of questions on your neck of the woods about rates. Oh, your buddy Mr. Mark Brandt's floating around the chat there, Mr. Nick. He's got a bunch of questions. He's talking about he thinks Bitcoin should earn interest and be more of a currency. I could see that, but he also talking rates. He wants to know if we like the knob spread here. Not a product, not a trade, not a spread. We talk about traditionally here on the old TWIFO show. If you're not familiar with that, it stands for the notes over bond spread. I don't know, Agha, this is your complex. Any thoughts on the knob spread? If it's how it's trading these days, and B, if you have any insights to share here with our listener who wants to know if we like this spread now.
I am, in my capacity, better off staying away from making interest rate forecasts. I will observe that obviously the curve has flattened, depending on how inflation shapes up to be. Historically, if the Fed continues to raise rates, particularly staying ahead of inflation, then the curve tends to flatten. That's just a general observation based on historic price action. I will let the market participants make their own calls and decisions on which trades to put.
It's just you and I here, and Nick, Agha. No one else listening to us, so it's just three guys talking here in a room. But no, I appreciate that. Even though, I think just informing people about this spread and its existence is probably useful for a lot of our listeners in and of itself. Mr. Nick, anything to add on either of these two topics?
No, yeah, I can't prognosticate too much on that, but just one thing, one point of clarity. For people that aren't familiar with the interest rates, right? For instance, what I was talking about the euro dollars and how the spread, how the prices of the euro dollars, you see the curve steepening, but that's the opposite for rates, right? So that's what Agha was saying. It's go in the other direction then. As far as the knob spread, you can go and I'll let people make their own, they could look at the historicals and see what they're doing, and they can kind of evaluate what they think inflation is going to be. And especially when you're starting to look between the 10s and the 30s, there has been some change over the last month and probably even more change over the last few months. But you can use the Treasury Analytics tool that's also out at cmegroup.com/IR and take a look and see what you think it's doing yourselves. I mean, there has been some changes, so I'm sure there'll be continued changes. But, why not take a look and follow it? We're keeping track of it for you out there instead of me sounding like I don't know what I'm talking about if I try to make a knob prediction, because that's not one I watch all the time.
There are many jokes to be made there, Mr. Nick, but I will let them hang. I will not make them for you. Instead, we'll wrap it up with one more. Rates questions, aplenty here today. Alejandro wants to know a topic we can probably spend a whole show on. We'll condense it into 2 minutes here. He wants to know, can you guys do an overview of Rho and its impact on options in a rising rate environment? Is this something that I should be concerned about? Quick overview, listeners. Rho, of course, and options sensitivity to interest rates. I often refer to it as the forgotten Greek, the red-headed stepchild of the Greeks, because it doesn't really get a lot of love. You can probably see why over the last 5 years, when the better part of rates were complex, were hovering at or around zero. Rho wasn't really a big factor. Most people were more interested in delta, gamma, theta, and vega. Those are the big Greeks that were really driving a lot of their portfolio risk and profits. These days, Rho, I think we can. Anecdotally, the more questions we're starting to get about Rho, people are starting to wake up to this Greek and what it means. But I would say for the lion's share of you who listen to this show and who write in, who are pretty active on the trading side, who are trading a lot of times in the weeklies or in very near duration contracts, Row in general is never really going to impact you very much unless we get into some extreme environments, because you're trading weeklies that are decaying at a rapid rate, or maybe most of you guys are probably trading not farther than the monthlies. So it's not a scenario where you really have a lot of worry about interest rates really messing up or impacting your options. If you're trading year, 2 years out, or far out there, and you're doing really meaty options with a lot of heavy cost to carry in the money type contracts, then row is going to be a big factor for you, and it's going to be more of a factor going forward as rates increase, and you'll see that priced into some longer term options as they're pricing in some rate increases already. But for the lion's share of you out there who are slinging a lot of weeklies, things that expire in a day or two or a week, maybe a month at the outset, you're not really going to see a lot of impact in row in most environments anyway. So a good question, but unfortunately that's all the time we got to answer your questions. It's also all the time we have for this episode of... Whoa. A little loud there, guys. There we go. That's better. Thank you. That's also all the time we have for this episode of Twifo. The music had to get in there. The music couldn't wait. But it is a fun tune, so we'll allow it. Of course, that music means we're done, listeners. Coming to a close of this epic journey through the world of futures options. But before we go, let me go back around the horn one last time. See what's cooking with our guests. Since we have Agha in the hot seat, it's burning. He wants to get out. It's uncomfortable for him. So we'll go back to him one last time. Agha, you mentioned it earlier, the URL, but if our listeners are interested in learning more about what you and your team have up your sleeves, or maybe you want to give them a little bit of a hint, a little bit of a tease of something you guys are working on over there in the rates complex, now is the time. The floor is yours.
First of all, I would like to thank you for having me on the show. Once again, one-stop shop for all interest rate information, cmegroup.com/IR. We also have a fairly popular monthly newsletter. We call it Rates Recap. You can access the Rates Recap and learn everything that is latest and greatest in our complex on the same website, cmegroup.com/IR. Thank you for having me over.
There you go. cmegroup.com/IR. While you're visiting the Twifo link, add a new tab and go to cmegroup.ir or /IR, I should say. And you can see all this good stuff, including the rates recap. A lot of good data for you guys to check out over there. Mr. Nick, I mentioned how you guys are always working on good stuff. You obviously polished up the FedWatch tool, but what else is coming down the pike over there in the land of Quick Strike these days?
We continue to try to release stuff in conjunction with the CME coming out this. I think it may be live this week, but might be next week. You'll see a Eurodollar Fed Fund spread report that's going to be out there as part of the suite of products, and in all likelihood, it's going to be on that IR page. I don't know specifically the timing, but we were trying to get it out there this weekend, so you can keep an eye out for that. And then, like I've been saying for the last few weeks, there will be a new strategy simulation is what it's going to be called. Strategy simulation tool that's going to be released by the CME that we've built in conjunction with them to get people who may not necessarily have a tremendous amount of options experience up and running in that part of the derivative market. So look out there, and of course, always learn more at bantix.com, or if you have any questions, you can shoot us a note at support@quickstrike.net, no C in the quick, or shoot me a note on Twitter. I'm glad to ask any questions, but we're releasing stuff all the time, so take a look at the free version first, and then if you're looking for more, take a look at the subscription version. We're glad to help you any way we can.
There you go. Check it out, bantix.com, BANTIX. You see that little blue button there. Click on it to get over to the Quick Strike and see all the cool tools, because there are some cool tools that Nick and his team are putting out there on an almost daily basis. On behalf of Mr. Nick and our guest Agha, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, listening live, sending in questions, all the fun stuff that you guys do. Keep it coming, and we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.